How's it going? I'm Jason, I'm your host. Welcome to the Week in YouTube Finance.
So what if I told you that Japan, a country with just 2% of the world's population, could disrupt the entire world?
Japan's government has released growth data for the first quarter of this year. And the numbers show the economy has taken a step back.
Japan's three biggest names in the auto industry announced disappointing numbers for the last quarter of the business year, and they're warning of rough waters ahead.
Rice prices in Japan remain stubbornly high. Consumers are struggling to put food on tables and retailers to put products on shelves at affordable prices.
The government has been trying to fix the problem with limited success.
Now, you probably don't spend a lot of time thinking about Japan's economy, and most people don't. It's on the other side of the world, and it's not in the headlines all the time like the US or China. But the reality is that Japan could increase interest rates in your country, crash stock portfolios all over the world, and potentially even trigger the next global recession. Because Japan is not just another country. It is one of the biggest creditors on earth. It holds over $1 trillion in US government debt, and for decades, it's been the engine that powered some of the world's riskiest financial bets through something called the yen carry trade. And the yen is one of the most important currencies in the world, and it's also getting stronger. But the thing about this story is that it's not just the story about Japan, it's a story about the end of an era, the era of easy money. And as Lynn Alden puts it, when the global debt is this high and the demographics this broken, there's really only one way out: currency devaluation and the gradual realization that nothing stops this train. Now, once that happens, money starts to look for other places to go, like scarce, decentralized, hard assets that can't be inflated away. Then it makes sense why people are buying things like Bitcoin. Because it's outside the system, it's finite, and doesn't care about bond auctions, it doesn't care about tariffs, can't be printed into oblivion, and that's why I've been making it such a big part of my personal investment strategy. Again, I've been dollar cost averaging into it for a long time because this story makes a lot of sense to me, and I have no idea what my sell price is. I don't really have one. And the truth is, part of me really wants to take a big part of my stock portfolio and convert it into Bitcoin, but I don't think I'd sleep as comfortably, so I'm holding on to my stocks because even if all of this is wrong, then I can still rely on stocks to get me to retirement because that's what data shows works in the long term. I'm staying invested regardless of what happens though, but I did find this to be a really interesting story. I've got time to see how all of this plays out, but I'd love to hear your thoughts. As always, I hope you have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. I'd love to see you back here next week. I'll see you soon. Bye-bye.
The House just passed the One Big Beautiful Bill, and this bill is filled with massive changes to how Americans will be taxed. But there is one section in it that really caught my attention, and it's the real game changers for folks like us who are real estate buyers, builders, investors, and business owners. Starting next year, businesses might be able to deduct 100% of their equipment, vehicles, and even certain building expenses, we'll talk more about that in a little bit, in the very first year. This could even apply to folks with W-2 income. Now, get ready because this means that you will have a small window to jump on some of the craziest opportunities in real estate. In this video, I'm going to break down exactly what 100% bonus depreciation actually means, what's changing, who benefits, and what steps you should take before the Senate decides the final outcome. Let's start with the basics. Bonus depreciation is a tax incentive that allows businesses to immediately deduct a large percentage of the purchase price of eligible assets like machinery, vehicles, or even certain types of building improvements. Instead of spreading that deduction over several years, which is often decades for us real estate investors. Now, under the 2017 Tax Cuts and Jobs Act, businesses could deduct 100% of their qualifying assets in the first year, but that began phasing out in 2023. Right now, it's only 40% in 2025, and it was scheduled to continue decreasing every year. But now, this new bill aims to reset that back to 100%, starting with assets purchased and placed into service after January 20th, 2025. This is a giant reset button for bonus depreciation. Now, here's the headline. If this bill becomes law, businesses would be allowed to claim 100% bonus depreciation on qualifying assets purchased and placed into service between January 20th, 2025, and December 31st, 2029. That's 5 more years of full upfront deductions on things like vehicles over 6,000 pounds, work-related equipment, furniture and fixtures for rentals, buildings and structures, land improvements like roads, fencing, and septic systems. And quite honestly, for real estate investors, that could mean tens or hundreds of thousands of dollars in tax write-offs in 1 year. This is essentially what Rob and I have been doing for the past several years, saving us millions of dollars in taxes. Now, the big question is, why is this important? Well, that's because cash flow is king at the end of the day. And when you can write off the entire cost of your improvements immediately, it reduces your taxable income and gives you more money to reinvest faster. Let me paint a picture. Imagine you're building a short-term rental on raw land. You spend $200,000 on a prefab or a kit home, $30,000 on infrastructure, and $20,000 furnishing and designing. If this bill passes, you could potentially write off all of that in the very first year. That's a potential $250,000 deduction, saving you upwards of $80,000 in taxes, depending on your income bracket. Now, this is absolutely huge for real estate developers, vacation rental owners, construction companies, and any businesses that have capital requirements. This new tax bill is incredibly powerful if you have a high income year coming up, or you're trying to offset gains from another investment. Okay, so what's the catch here? This bill has passed the House, which is a massive deal, but not the Senate yet. That means it's still up for debate. The Senate could make changes, delay it, or even stall it altogether. I think they're going to try to edit and tweak certain things in the bill, but I don't think they're going to outright just shut it down. But the fact that it passed the House with support, although it was really close, suggests that this does have momentum moving forward, especially heading into midterms where economic stimulus is a big talking point. We'll likely see a lot of movement and action on this over the next few weeks to months, and if passed, it would go into effect starting January 20th, 2025 for us real estate investors. If you want me to break down what qualifies or how to use the strategy for your own business, see you in the next one.
President Donald Trump's Liberation Day tariffs will remain in effect for now, despite Wednesday's ruling declaring them unlawful, as a federal appeals court ruled Thursday that the tariffs can stay while it deliberates on the case, though they could still be struck down later. That means Trump's Liberation Day tariffs will remain in place until at least June 9th, while the appeals court decides whether or not to uphold the Court of International Trade's ruling. The Trump administration asked for the tariffs to stay in effect while they appeal Wednesday's ruling, in which the Court of International Trade struck down Trump's sweeping April 2nd tariffs as being unlawful because the president didn't have the authority to impose sweeping tariffs under the law he used to justify them.
Every quarter, Wall Street's biggest names, Warren Buffett, Seth Klarman, Bill Ackman, Monish Pabrai, Michael Burry and so on, quietly file one document that gives us a rare glimpse inside their portfolios. And just last week, we got the latest installment. So in this video, we're diving into the brand new 13F filings for Q1 of 2025. And as per usual, there are some seriously eyebrow-raising moves being made by the smart money right now. So with that said, here are the 5 most notable stories coming out of this quarter's 13F filings that you need to know about. And the first comes from the GOAT himself, Mr. Warren Buffett. While the main story of the quarter was how Buffett continued to struggle finding opportunities, growing his cash pile even further to $350 billion, there was a notable sell at the top of his portfolio, and that was in Bank of America. And this is quite significant. Bank of America has been one of Buffett's crown jewels ever since the aftermath of the GFC. To him, it's not just a holding, it's been a high conviction bet for well over a decade. As you can see, Bank of America has been Buffett's second largest holding since 2018, but over the past 3 quarters, he has been selling, and the company has now fallen to Berkshire's 4th largest position, occupying just 10% of the portfolio. Please like the video if you enjoyed it. I'll see you guys in the next one.
So here I am. I made it to episode 20. This is supposed to be going to 100. That's the challenge. We'll see how far I make it with your help. How can you help? Subscribe. That at least tells the YouTubes, tell the algorithms, tell the gods and universes and everyone involved that I'm trying. I'm trying to do well. So back me up if you can. Thank you. Weird, right?